Hi friends, in this video we are going to discuss inventory topic. That in inventory topic we are going to see stock taking, that is stock counting. Friends, stock counting may not take place always on 31st March, especially in case of large business organizations. Stock taking may be done before 1 week or 10 days, or sometimes it may take after 1 week or 10 days. But we need the value of the closing stock at cost price as on very 31st March to ascertain true financial results as well as true financial position of the business concern. And hence, if stock taking is done before the preparation of balance sheet, and if stock taking is done after the preparation of balance sheet date, the stock is to be adjusted to arrive at the correct closing stock as on 31st March. Friends, we'll discuss the same taking some examples. Here, closes its books on 31st December. Friends, I repeat, here the firm is closing its books on 31st December. Stock taking on 7th January. Friends, stock taking is been done on 7th January, that is after 1 week of the closure of the books of accounts, friends, that is after 31st December. Rupees 78,500. Purchases during the period of January 1 to 7th, 15,300, friends. Sales during the same period 25,000. Markup, that is loading, being 25% on cost. We are asked to show the stock as on 31st December. Friends, stock ascertained on January 7th, that is after 1 week, 78,500, friends, as given in the problem. Then purchases during the period of January 1 to 7th. I repeat, friends, purchases during the period of January 1 to 7th, 15,300. No adjustment is required to the purchases, friends, with regard to cost adjustment. Okay, since purchases are shown at cost price only. Friends, one more thing I want to make it clear, friends. Closing stock is to be valued at its cost price or NRV, that is net realizable value, whichever is less, as per the concept of prudence as well as the relevant accounting standard AS2 inventory valuation. Friends, here whatever the purchase have been made during the period of January 1 to 7, those purchases belonging to the current year, not to the previous year. And hence, because of these purchases, stock balance is going up and hence it is to be deducted. I repeat, friends, whatever the purchases have been made, those purchases belonging to the current year, and current year, it reflects in the current year closing stock. Okay, so since these purchases have been made, the closing stock which is ascertained as on 7th January 78,500 is being overstated. Since the purchase have been included in the 78,500, and whatever the purchase have been made during this period are to be deducted to ascertain the true closing stock as on 31st December, friends. And then sales during the same period, 25,000. I repeat, friends, sales during the same period 25,000 rupees. Friends, here we know that whatever the sales have been made, those sales belonging to the current year, and because of such sales, stock levels have come down and that stock is to be added back. Friends, I repeat, friends, stock balance has come down because of the sales and hence the same is to be added. And then here the stock is to be shown at its cost price, friends. Here sale price is 25,000. We are given that markup loading being 25% on cost. Friends, 25% on cost is equal to, that is 1/4 on cost is equal to 1/5 on sales, that is 1/5 on sales is equal to 1/4 on cost. So here 25% on cost is equal to 1/4 on cost, that is 1/4 on cost is equal to 1/5 on sales. So in this 25,000 sales figure, markup of 25,000 is included, friends. That markup is to be eliminated to arrive at its cost price, that is 25,000 selling price into 100 by 100 plus rate, friends. I repeat, selling price into 100 by 100 plus rate, then we arrive at cost price. Otherwise, friends, we can directly eliminate the loading, that is 25,000 into rate by 100 plus rate, that is 5,000 rupees. 25,000 minus 5,000 is equal to 20,000. Okay, the same is to be added back, then we arrive at 83,200. 83,200 is the correct closing stock, that is true closing stock as on 31st December of the previous year, friends. Friends, here we discuss one more example, that is example number 2. A trader prepared his accounts on 31st March each year. Due to some unavoidable reasons, no stock taking could be possible till 15th April 2019. I repeat friends, a trader prepared his accounts on 31st March each year. Due to some unavoidable reasons, no stock taking could be possible till 15th April 2019, on which date the total cost of the goods in his godown came to rupees 50,000. That is stock taking on 15th April 2019 is rupees 15,000 friends. That is stock taking took place after 15 days of the closure of the financial year friends. The following facts were established between 31st March and 15th April. This is very, very important friends. The following transactions took place in between 31st March and 15th April. Number 1, sales rupees 41,000 including cash sales rupees 10,000. Friends, here it may be a cash sale or a credit sale, stock is going to come down, so cash sale information is not relevant. The entire sales we need to take into account friends. Purchases 5030 friends, that is 5034 including cash purchase of rupees 1990. Again here whatever the purchase have been made, we need to take into consideration. It is relevant whether it is a cash purchase or credit purchase friends, and hence total purchase of rupees 5034 is to be taken into account while adjusting the stock. Then sales returns rupees 1000. Goods are sold by the trader at a profit of 20% on sales friends. Whereas in the previous problem we are given 25% on cost, that is 1/4 on cost is equal to 1/5 on sales. Here in this problem directly we are given 20% on sales. You are required to ascertain the value of inventory as on 31st March 2019. Friends, let us see the solution for the same friends. So statement of valuation of stock on 31st March 2019. Value of stock as on 15th April 2019 rupees 50,000 friends given in the problem. That is value of closing stock as on 15th April 2019 is rupees 50,000. Value of stock as on 15th April 2019 is 50,000. Now we need to make the adjustment friends. Here again the stock taking to place after the preparation of balance sheet, that is after 15 days, and we need to adjust the transactions which have been taken place in between 1st April and 15th April 2019 friends, to arrive at correct stock as on 31st March 2019 of the previous year. Then here sales rupees 41,000 including cash sales rupees 10,000, and friends even we have sales returns of rupees 1,000. Friends, I repeat, sales rupees 41,000 include cash sales. Already I told you that it may be cash sale or credit sale. Okay, the stock is going to move out, and sales returns, because the sales returns the stock is going to come in. Then actual stock flows is 41,000 minus 1,000, that is 40,000 friends. I repeat friends, sales 41,000, sales returns 1,000. Sales, it is outflow of sales 41,000 outflow of the stock, 1,000 sales returns inflow of the stock. So net outflow of the stock is 40,000 friends, subtracting 41,000 minus 1,000, that is 40,000 friends. Here again, okay, already we have discussed that the stock is to be shown at its cost price, then cost of the goods sold during the period from 31st March 2019 to 15th April 2019, that is sales figure, that is 41,000 minus sales returns 1,000 is equal to 40,000. Since we are given goods are sold by the trader at a profit of 20% on sales, directly we are given friends 20% on sales, so directly we will take here 20% on sales, that is 40,000 at the rate of 20% is equal to 8,000. Then by deducting 8,000 from 40,000 we arrive at cost of goods sold during the period friends. Here again we are adding friends, similar to that of previous problem, we are adding the cost of goods sold friends. Because of such sales, stock balance is coming down, and hence it is to be added to arrive at correct closing stock on 31st March. I repeat friends, because of the sales, stock balance is going to come down. To arrive at correct stock balance, we need to add it back. Then purchases friends, purchases rupees 5,034 including cash purchase of rupees 9090. Already I told you friends, it may be cash purchase or credit purchases. Total purchases we have to take into consideration. Such purchases made during the period are to be deducted since those purchases belong to the current year, and current year stock is being added up, increased to arrive at the correct closing stock on 31st March 2019, whatever the purchase have been made during the period of 1st April and 15th April ought to be reduced, friends. That is 5034 is to be reduced from 82,000. Then we arrive at 76,966, and this is the correct closing stock as on the 1st March 2019, friends. We will discuss one more problem which is given in our textbook. That is, stock taking for the year ended 30th September 2009 was completed by 10th October 2009. Friends, again here, stock taking for the year ended 31st September was completed by 10th October 2009. That is, after 10 days, the stock taking has been taken place. Friends, the valuation of which showed stock figure of 1,67,500 at cost as on the completion date, that is as on the 10th October 2009, the value of the stock arrived at is 1,67,500. After the end of accounting year and till the date of completion of stock taking, sales for the next year were made for 6,875. Profit margin being 33.33% on cost. I repeat, friends, profit margin being 33.33% on cost, that is 1/3 on cost. 1/3 on cost is equal to 1/4 on sales, friends. And since in this 6,875, okay, 1/4 of the loading is been included, the same is to be adjusted to arrive at correct cost figure. Purchases for the next year included in the stock amounted to rupees 9,000 at cost less trade discount 10%. Friends, if any trade discount is been included in the stock, that such trade discount is to be adjusted. Then from this 9,000, 10% trade discount is to be adjusted. Then we arrive at 9,000 minus 900, 8,100, friends. During this period, goods were added to stock at the markup price of 300. In respect of sales returns, again, friends, this 300 is the markup price, that is loading price, that is selling price. Then in this 300, again 1/4 of loading is been included, that 1/4 of the loading is to be deducted, friends. 1/4 of rupees 300 is equal to rupees 75. Then in respect of sales returns, after stock taking, it was found that there were certain very old slow moving items costing rupees 1,125, which should be taken at rupees 525 to ensure disposal to an interested customer. Due to heavy flood, certain goods costing rupees 1,550 were received from the supplier beyond the delivery date of customer. As a result, the customer refused to take delivery, and net realizable value of the goods was estimated to be rupees 1,1250 on 30th September. Compute the value of stock for inclusion in the final accounts for the year ended 30th September 2009, friends. Now let us see the detailed solution, friends. That is, statement showing the valuation of stock as on 30th September 2009. See, friends, the value of stock as on 10th October 2009 is 1,67,500. I repeat, friends, the value of the stock as on 10th October, that is the stock which has been taken place after 10 days of the closure of the books of account, that is for the year ended 30th September, is 1,67,500, and that will be the base figure, friends. Then we are given that sales for the next year were made for 6,875, profit margin being 33.33% on cost, friends. Friends, already I told you, friends, profit margin of 33.33% on cost, that is 1/3 on cost is equal to 1/4 on selling price, that is 25% on the selling price. So 6,875, we need to, from 6,875 we need to deduct 25% of the loading, that amounts to 1,719, friends. I repeat, friends, in this 6,875, 25% of the loading is included. To arrive at its cost of goods sold, that 1/4 of the loading which has been included in this 6,875 is to be eliminated to arrive at correct cost of goods sold, friends, and same is to be added as discussed earlier, friends. Then purchases amount rupees 9,000 at costless trade discount of 10%. Just now I told you, friends. Okay, purchases, from the purchases 10% trade discount, that is 900 is to be deducted, then 8,100 is to be deducted because cost of sales returns, friends. Here, during this period, goods were added to the stock at markup price of 300 in respect of sales returns. Okay, in this 300, markup of 1/4 is being included, friends. That 1/4 is to be deducted, that is 300 at the rate of 1/4 amounts to 75 rupees. Then 300 minus 75, 225 rupees to be deducted to arrive at the correct closing stock, friends. If any sales during the period are to be added, if any sales returns are to be deducted, friends. So then next, in respect of after stock taking, it was found that there were certain very old slow moving items costing rupees 1125 which should be taken at 525 to ensure disposal to an interested customer. I repeat, friends, after stock taking, it was found that there were certain very old slow moving items costing 1125. Actually, their cost is 1125, friends, but which should be taken at 525 only. The difference is 600. The value of the stock is going to come down, okay, because of rupees 525, where the value of the stock is 1125. The difference in between 1125 and 525 does amount to loss on revaluation of the slow moving inventories, friends. That is 600 is to be reduced since the value of the stock has come down, friends. The next, due to heavy flood, certain goods costing rupees 1550 were received from the supplier beyond the delivery date of customer. As a result, the customer refused to take delivery and net realizable value of the goods were estimated to be 250. Again, similar adjustment we can do, friends. Here, actual the cost of the goods is 1550, but whereas they were revalued at rupees 1250, and again there is a reduction in the value of the asset by rupees 300, that is difference between 1550 and 1250, and the same is to be reduced to arrive at the correct closing stock, friends. So then after adjusting 5156, that is 5156 to be added, then 8100 purchases made during the year is to be deducted, 225 sales return is to be deducted, and loss on revaluation of slow moving inventories is to be deducted, reduction value of account of default is to be deducted. Then we arrive at 1,63,431, and that is the correct closing stock, friends. Thank you.